Now speaking, Zach George, Chief Executive Officer. SNDL's Q2 2023 earnings call highlights our incredible growth, with potential $1 billion in annual revenue and record gross margin of $52 million, a 20% year-over-year increase. Our diversification strategy and operational improvements have been instrumental in achieving these milestones. We are focused on driving greater efficiencies and reaching profitability in 2024. In our liquor retail segment, we are launching an e-commerce platform and optimizing profitability through margin-accretive opportunities. In cannabis retail, our data licensing program and new loyalty program are enhancing profitability and market position. The closing of the strategic transaction with Nova has been delayed, but we anticipate closing by August 25, 2023. We continue to explore organic growth and M&A opportunities to strengthen our market position. Our cannabis operations have implemented cost-cutting measures and leveraged manufacturing capabilities, resulting in an impressive 80% YoY increase in revenue. We have divested from equity securities and certain credit exposures, and hold $754 million in unrestricted cash and investments. Sunstream's credit portfolio includes investments in Jushi Holdings, SKYMINT Brands, Ascend Wellness Holdings, Parallel, Columbia Care, and AFC Gamma. We are exploring a restructuring and transfer of certain credit interests to a new U.S. holding entity, Sunstream USA, to comply with U.S. laws. Integration initiatives have achieved $18.2 million in annualized cost savings, surpassing our target, and we aim to exceed $30 million in savings by 2024. We welcome our new CFO, Alberto Paradero, who brings extensive experience in corporate finance. Overall, we are confident in our future success and maximizing value for shareholders. Now speaking, Alberto Paradero, Chief Financial Officer. Good afternoon, investors. I'm excited to be leading SNDL's quarterly earnings call and sharing our Q2 2023 results. Let's dive right in. We achieved record net revenue of $245 million, a 9% increase compared to the same period last year. Our gross margin hit an all-time high of $52 million, driven by revenue growth, product mix improvements, and productivity enhancements. Our adjusted EBITDA reached a positive $2.2 million, a significant improvement from the $26 million losses in Q2 2022. We've been running our operations more efficiently, with a 51% improvement in cash used in operating activities. We have a strong financial position with $754 million in cash, marketable securities, and long-term investments. Our cannabis retail segment saw net revenue of $72 million, a 13% increase year-over-year, and a record since SNDL diversified into cannabis retail. Gross margin return for this segment was nearly $18 million, a strong 28% increase compared to Q2 2022. We've optimized our proprietary data licensing program, generating $2.7 million in revenue this quarter. In terms of investments and liquidity, SNDL has invested $569 million in a portfolio of cannabis-related ventures, with $532.8 million invested through the Sunstream joint venture. We made a strategic decision to divest certain investments, resulting in a net loss of $1.5 million. We're carefully considering our options for a share repurchase program and will provide further details soon. We're committed to regulatory compliance and have paid $23.4 million in excise taxes this year, totaling $67.8 million since inception. SNDL is focused on standardization, cost control, and operational excellence to fuel lasting and profitable growth. We believe SNDL has what it takes to come out on top. Thank you, and now I'll pass the call to Tank for an update on the liquor retail results. Now speaking, Tank Vander, President, Liquor Retail. SNDL had a positive Q2 2023 with record revenue growth and increased gross margin, driven by liquor retail. Our liquor retail segment operates around 170 locations in Alberta under 3 banners, Wide and Beyond, Liquor Depot, and Ace Liquor. Our market share in Alberta was approximately 18% in Q2 2023. Liquor Depot and Ace Liquor accounted for 76% of this quarter's revenue, and our convenience banners are well positioned to capitalize on transactional shoppers. Same-store sales increased 1.7% across all liquor banners, with Liquor Depot and Ace Liquor seeing 5.6% and 2.8% growth, respectively. Gross margin in the liquor retail segment was $35.4 million or 23.3% of sales in Q2 2023. We are exploring strategies to increase gross margin growth, including inventory controls, price optimization, and customer retention and engagement. Preferred label sales increased 28% compared to the same period last year, and we have added additional value offerings in our preferred label line. SNDL will launch an e-commerce platform for Wine and Beyond in Q3 2023 to drive revenue and increase customer engagement. We will continue to focus on margin growth and customer reach in the second half of the year. Now speaking, Tyler Robson, President, Cannabis. Our cannabis segment has shown strong progress this quarter, driven by our focus on leveraging vertical integration and expanding our retail market share. We have optimized our manufacturing, processing, and cultivation activities, resulting in significant cost savings. SNDL's cannabis platform is critical to our vertical integration strategy, driving market share growth and improving costs and gross margin. Our revenue for the quarter was $21 million, an 80% increase compared to Q2 2022 and a 9% increase compared to Q1 2023. Gross margin also showed solid improvement, with negative $1.2 million compared to negative $4.3 million in Q2 2022 and negative $9.5 million in Q1 2023. We have implemented aggressive cost-cutting measures and improved manufacturing productivity, including right-sizing cultivation in Alberta and consolidating manufacturing activities in Kelowna. Our cultivation yields are approaching 100 grams per square foot in Alberta, with a substantial increase of nearly 30% in Olds. We have evaluated our portfolio and made data-driven decisions to enhance our market positioning and product offerings. Driving increased owned retail share is a key focus, and we have partnered with Cold House Direct for sales and logistics execution. We are actively exploring strategies to capitalize on untapped opportunities in British Columbia and Quebec. We remain confident in our ability to drive revenue growth in the B2B segment, both domestically and internationally. We are simplifying our segment, focusing on fundamentals and innovation, and remain agile and hyper-focused on optimizing our cannabis segment for margin expansion and continued revenue growth. Our team is committed to delivering exceptional customer value and building long-lasting industry relationships. We are excited about the potential for growth and delivering long-term shareholder value. Thank you. Now speaking, Zach George, Chief Executive Officer. We have achieved significant milestones this quarter and are committed to driving profitability and shareholder value. Our team remains dedicated to reaching our objective of free cash flow by 2024. We appreciate the support of our stakeholders and commercial partners and look forward to updating you on our progress. ATB Capital Markets analyst Frederico Gomez inquired, "Can you provide an update on the margins in your liquor retail segment? Specifically, can you confirm if the record margins achieved in July are expected to continue in Q3 and Q4? Additionally, what impact do you anticipate the launch of e-commerce for wine and beyond will have on margins?" Zach George replied, "Thank you for the question. We are indeed excited about the current business environment and our ability to maintain and improve our margin profile. While we are not providing forward guidance, we are cautiously optimistic. As for the launch of our e-commerce platform, we believe it presents a significant opportunity for our business. It allows us to reach a wider customer base and enhance our overall sales and profitability. We are closely monitoring any potential challenges and are confident in our ability to navigate them successfully." Tank Vander replied, "Thank you for your question. We are excited to announce that we will be launching our e-commerce platform this quarter. This strategic move aligns with the current trend of retail shifting online. We anticipate significant benefits from this transition, including improved margins and increased volumes for our wine and beyond business." ATB Capital Markets analyst Frederico Gomez inquired, "On your cannabis operations, how much of the profitability in that segment do you think is within your control, and how much relies on cost-cutting and changes in the macro environment to reach profitability?" Zach George replied, "Our focus is on high-quality, low-cost production in key product segments. The transition we made after acquiring Valens involved relocating our processing and manufacturing activities from Olds to Kelowna. This transition has caused some noise and messiness, as we anticipated. However, we believe that this move is radically changing our cost structure, making us more competitive in the cannabis industry." Tyler, could you provide further details on our competitiveness? Tyler Robson replied, "Absolutely, you've captured the essence of our situation perfectly. We anticipated being able to achieve profitability within the current market conditions, and we have taken significant steps towards that goal. While there is still work to be done, I am confident that we are on track to achieve profitability as planned. Rest assured, we are in a secure position moving forward." ATB Capital Markets analyst Frederico Gomez inquired, "Regarding your cash flow goal for 2024, which segments do you anticipate will be the largest contributors?" Zach George replied, "Historically, our liquor segment has shown strong potential for operational cash flow. However, our goal for 2024 is to achieve positive cash flow from all segments. We are confident in achieving this through a combination of growth and cost management, leveraging a more efficient shared services structure. This approach allows us to focus on both revenue growth and cost reduction simultaneously, which is a challenging feat. Nonetheless, we are successfully executing this strategy." Canaccord Genuity analyst Yun Kang inquired, "Could you please provide an update on the cost-saving measures in place to achieve positive free cash flow from the cannabis cultivation segment by fiscal 24? Additionally, what can we expect in terms of margin expansion for this segment in the remainder of fiscal 23? Zach George replied, "Certainly, I'd be happy to provide some insights on our supply chain initiatives and SKU rationalization efforts. These strategic measures have been instrumental in enhancing the focus of our teams and optimizing our margin profile. By streamlining our supply chain processes and rationalizing our SKU portfolio, we have been able to improve operational efficiency." Tyler Robson replied, "Since January, we have made significant improvements in our cultivation facilities, resulting in higher potency and yield. Our strategy of SKU optimization has allowed us to focus on fewer, but better products. In the cannabis segment, having the right footprint and utilizing our low-cost biomass procurement has helped us drive the premium segment. While we cannot provide specific forward guidance on margins, we expect them to continue improving as we optimize our entire portfolio. With the momentum we are currently experiencing, we are optimistic about the future." Zuanic and Associates analyst Pablo Zuanic inquired, "Can you provide more information on the plans with Sunstream USA? Specifically, what will happen to the other debt holders of SKYMINT in parallel when you equitize your debt holdings? Additionally, Canopy Growth had to backtrack on their plans for the Cannabis USA structure to comply with NASDAQ. Why do you believe your case will be different and that NASDAQ will approve it?" Zach George replied, "Regarding the timing of disclosures for SKYMINT in parallel, it's important to note that these two entities are going through different processes. SKYMINT is currently in a receivership process, which involved an auction that has been completed. However, the transaction cannot be finalized until a court ruling is made in early September. Therefore, we cannot provide certainty until that court date. On the other hand, Parallel has licenses in multiple states and a more complex capital structure, which requires agreement among stakeholders to reach a resolution through a foreclosure process. We expect to provide more clarity on the pro forma and go-forward capital structures for these businesses within the quarter. As for Canopy, we are unable to address any conversations between Canopy and regulators as we do not have knowledge of them. However, it is worth noting that the consolidation of financials has been a debated issue among various exchanges. TerraSend and Curaleaf, for example, are looking to uplift on the TSX. We believe the consolidation of financials will evolve over time, and we are committed to fulfilling our regulatory obligations. We are actively working with regulators on compliance structures to effectively manage our business and exposures. Regarding our credit portfolio, it is currently owned through a joint venture called Sunstream. As credits potentially become equitized, the character of our credit portfolio will change. It's important to recognize that different companies in the industry are taking different paths, and we are focused on our own unique approach. Zuanic and Associates analyst Pablo Zuanic inquired, "Can you provide an update on the plans for the retail side of cannabis, specifically regarding Nova? What are the considerations for comparing franchisees to company-owned stores under the Nova banner in terms of capital allocation? Additionally, when do you anticipate spinning off the entity to SNDL shareholders once you own 100%? Zach George replied, "Yes, we are exploring opportunities for growth through our corporate and franchise model. Some franchise partners may be interested in owning a stake in our broader business, beyond their individual location. We have also acquired a few retail licenses that will be converted over time. We believe that focusing on a small number of banners is the best way to allocate resources and build brands. Additionally, we are keeping an eye on distressed individual and portfolio sales in the marketplace, while being mindful of the cost of capital for potential transactions." Zuanic and Associates analyst Pablo Zuanic inquired, "Can you clarify if the prioritization of returning capital to shareholders mentioned in the press release refers to a large one-time dividend or share buybacks to improve localization?" Zach George replied, "Our company has a strong track record of raising equity capital, achieving an evaluation of 15 times revenue at its peak. Currently, our stock is trading at approximately 0.5 times revenue, indicating that it is undervalued. We are actively exploring various avenues to enhance shareholder value, including organic and acquisitive growth. Additionally, we believe our equity is priced too low and may consider repurchasing shares to return capital to our investors. Furthermore, we are in discussions regarding the possibility of distributing Nova equity to SNDL holders, pending regulatory approval." Stifel Financial Corporation analyst Andrew Partheniou inquired, "Can you discuss any consumer trends you are observing in your cannabis and liquor retail businesses, particularly in relation to the pressure mentioned earlier and the positive same-store sales growth in Liquor Depot, Ace Liquor, and preferred label liquor sales?" Zach George replied, "We are experiencing some pressure on sales volume in both the Canadian cannabis market and certain markets in the U.S. This is due to a combination of factors, including the current stage of market maturity and various challenges faced by consumers. We have observed a slight decline in sales volume, specifically in the low single digits. However, we have also noticed an increase in the frequency of purchases from our core consumer base. While the number of individual purchases per trip has decreased slightly, the overall number of trips made by our customers has increased. Tank will provide further insights into the dynamics of our banners and product mix in the liquor segment, which has been particularly interesting. Tank Vander replied, "Thank you for your question. We have observed a shift in consumer behavior towards off-premise consumption due to the high cost of inflation. To address this, we are focusing on providing more value products in our private label offerings. This will help consumers navigate the current higher inflationary environment. Additionally, we have noticed a trend of premiumization in urban centers, while our rural markets are placing more emphasis on value." Stifel Financial Corporation analyst Andrew Partheniou inquired, "Could you please provide an update on the margin profile of your preferred label in the liquor segments and discuss the outlook for the future?" Tank Vander replied, "Our margin profile is higher for private label products compared to our overall margins. This is due to our strategic selection of partners and products from different regions, allowing us to remain competitive against national brands. However, it's important to note that margins can vary based on the specific product, but I won't go into detail on individual products at this time." Stifel Financial Corporation analyst Andrew Partheniou inquired, "Could you provide an update on your vertical integration strategy in the cannabis segments in Canada? Specifically, I would like to know the progress you have made so far and the percentage of shelf space occupied by SNDL products. Additionally, if possible, could you share any targets or timing related to this strategy?" Zach George replied, "We are not providing guidance on our share of shelves in our own retail stores at this time due to the evolving nature of the situation. However, since the Alcanna acquisition in March 2022, SNDL has significantly increased its representation in the Value Buds network. We are also exploring opportunities for co-manufacturing and working with other LPs to develop branded products for consumers. In addition to our own retail demand, we are also focused on expanding our distribution channels. As this segment continues to grow, we are being cautious in providing granular details on shelf space as we finalize our shared services infrastructure." Stifel Financial Corporation analyst Andrew Partheniou inquired, "Can you provide an update on the realization of the $18 million run rate cost savings achieved since the Valens acquisition in January? Specifically, can you clarify if the $18 million was fully realized in Q2? Additionally, could you please provide a breakdown of how much of the cost savings is attributed to cannabis operations SG&A, COGS, and corporate costs? Lastly, can you share any information on the distribution of the remaining cost savings across these three categories?" Zach George replied, "Our $18 million run rate was achieved through Q1 and Q2, and our work will continue into 2024. We are currently going through a transition that doesn't neatly fit into individual quarters. We are working to reduce fixed costs and have already significantly reduced variable costs. We are also focused on reducing our cultivation activity and optimizing our procurement to improve our working capital position. While we can't provide specific details on cost savings at this time, we expect a material improvement in COGS. Our cost initiatives are a result of a detailed plan developed with our internal team and an outside consultant. This plan focuses on rationalizing our cannabis operations business and has implications for cannabis retail and our corporate structure. We are striving to right-size the business and leverage the innovation and product development capabilities of Balance while moving away from higher-cost cultivation." Stifel Financial Corporation analyst Andrew Partheniou inquired, "Can you provide an update on the progress of monetizing the acquired biomass and what we should expect in the future?" Zach George replied, "Yes, in Q3 we expect to provide more clarity on our financials. Our acquisition has positioned us as one of the largest procurers and consumers of biomass in the country, giving us excellent visibility and pricing capabilities. This allows us to efficiently monetize our inventory. While there is still work to be done, we have a clear focus on our expected outcomes." Zach George replied, "Thank you for joining us today. We appreciate your participation and look forward to providing you with future updates."